Hello and good morning. Welcome to this presentation of our results in the second quarter of this year. My name is Birgir Jónsson and I'm the CEO of Play. I will go over how the quarter has been going. Þóra Eggertsdóttir, our CFO, will come and talk about the numbers and the financial results, and then I will come back and discuss the outlook. We encourage you to send questions on the email ir@flyplay.com, ir@flyplay.com, and we will aim to answer them at the end of the presentation. And now, without further ado, let's get on with the show. The second quarter can be summarized in a way to say that this is basically the last quarter of the build-up phase of the company. This is the quarter where the transformation happens from a point-to-point airline to a hub-and-spoke airline. And the message that we will deliver today is very impacted by that, both the financial results and also the operational numbers. So it's quite interesting to see this transformation happen within this short period of time. We flew around 180,000 passengers in the quarter. Our load factor was 74.8%, and with an on-time performance of 86%, which is quite an achievement in a really difficult and challenging environment, especially because we're launching a lot of new destinations. There's a lot of new handling agents, new airports, and a lot of new things happening in a very challenging time because of the ramp-up of COVID, as we have seen in the media, lack of staff in the airports, and basically a difficult time for the aviation industry. We finally built the company up from 3 aircraft to 6, and the 6th aircraft came into operation in June. And so at the end of the quarter, we were basically up and running with the full network in the first stage of the growth saga of the company. And we can also see that reflected in the mix of passengers, because for the first time we see the connecting passengers, the via passengers, being 26% of the passenger numbers, to passengers, which is basically tourists coming to Iceland, being 30%, and from passengers can be described as Icelanders going abroad, 44% of the passenger mix. And if we break it into the months in the quarter, April was kind of the lowest month when you look at the passenger numbers. We flew about 37,000 passengers, and we began launching new destinations. We had the first U.S. Destination, Baltimore, Washington, and then new destinations followed after that. We saw it in the growth in passenger numbers. For example, in May, we were up to 56,000 passengers, 87,000 passengers in June, and then, as we have reported, 110,000 passengers in July. So you can see how the kind of extra capacity and the added capacity with new aircraft is really impacting the number of passengers and, of course, the revenue of the company. So again, this is basically a transformation quarter where we really take flight and launch the model that we have been talking about since we began operation, the hub and spoke transatlantic model. And like I said, a lot of new destinations. And this is not only dots on maps, this is individual contracts, new handling agents, all kinds of operations, marketing focus. So you're basically launching a lot of new products. You can describe Play as being an export company, being active in 25, 30 foreign markets. So that's really a very complex dynamic, and is again impacted by higher cost and a lot of kind of focus in the quarter. It's interesting to compare our ramp up to what was happening in the aviation industry at the same period. And this graph aims to show how much our capacity grew. For example, if we take January of this year, you can see the red line is our capacity growth compared to the industry. The dotted line is the Keflavik, our hub capacity increase. The blue line is within Europe, and the yellow line is transatlantic capacity. So our ramp up is really something else when you compare it to the industry. And what is also interesting to look at is that over 60% of our capacity basically is going into routes or destinations that were not previously served from Iceland. That is good and interesting in the sense that this is a great news for the Icelandic tourism industry. This is opening gateways to the country and bringing new tourists in from new destinations, and also Play as a company is going into markets where we don't have so much direct head-to-head competition on these destinations. So this is a good metric of how our network planning has been working, and basically how we're optimizing our route network. While all this is happening and we are increasing our capacity, we are ramping up, we are taking delivery of new aircraft, we are training new people, we are launching new destinations with a lot of marketing cost. We saw this historic spike of oil prices, of course, and you can see that from February. We all knew what happened in February with this terrible invasion of the Ukraine. Oil prices spiked, and this for us is happening, of course, at a very inconvenient time. But thankfully, we can see that the oil price is coming down again. But we cannot hide the fact that this is making the quarter worse than it had to be, and hit us at basically a very inconvenient and a sensitive time. But things are beginning to stabilize, and our revenue is going up. So thankfully we can look at the future in a brighter light. Another interesting thing is that, and of course we have been coming here and talking about the business model and how the economies of scale is important in aviation. And the basic way to describe this is that we have had the fixed cost and the cost base of the company. It was already in place and basically active before we had the revenue-making equipment to make the revenue. So basically, when we were operating 3 aircraft in April, we had quite a substantial fixed cost, because that's the way aviation works. We need to train people, we need to do all kinds of things to prepare. Then we add 3 more aircraft, and the economies of scale come into play, and the underlying efficiency of the business model becomes clear. And we can see that if we just take the cost base of the company out and divide it from the fuel, which we call the ex-fuel CASK or cost per available seat kilometer, and we can see that we are reaching our target of having that under 4 US cents. We were down to 3.6 in June, and we can see on preliminary management accounts that we are even lower in July. So the business model and the efficiencies are there. Of course, we cannot discount the fuel price. That's a very negative thing. But as soon as that's coming down, as it is happening now in the market, we become it basically hits our profitability in a very positive manner. Again, just to try to explain this capacity increase that happened and what happened in the quarter. If we look at the load factor from the beginning of the company, we of course knew that we were starting in COVID, the demand was quite soft, there was quite a lot of uncertainty, but as we get into the spring and into this quarter, and then beyond the quarter, because we have already reported July numbers already, we can see that the load factor is growing quite a lot, and more importantly, our unit revenue or the RASK is also growing. So we can say once again that the second quarter is the investment phase. We needed that kind of base or this fixed cost in an accounting terms to basically be able to generate the revenue that we are seeing happening after the quarter. May is always a difficult month. You can see the RASK is going down there in May. That's simply because we are launching a lot of new destinations. And when you do that, you have this kind of directionality problems because people are going. It's easy to explain within Iceland or a local market. People are going, let's say, to Spain, but we don't have people in Spain that are coming to Iceland in the same number. So once you get the destination up and running, you see a more even load factor. And when you launch a lot of new destinations at the same time, this directionality problem becomes greater. But in aviation, you need to fly because we need to train crew, and also in May, people are not maybe going on holiday as much as they're doing in June and July. So the demand is softer, and we have to stimulate it with price. So this is May is a kind of a difficult month in aviation. But as soon as we're into the summer and we see a more kind of even spread of people going back and forth between the destinations, we see this dynamic changing. And the underlying profitability of the company is also improving with that. As we are reporting now, we are still in loss, in our operating loss or the EBIT loss in the quarter. But this is a situation that we see changing as like I said, we see the revenue growing and the kind of underlying efficiency of the business model come into play, and we will maybe go into that in more detail later. Well, about the company, we already have over 300 employees. They are of 17 nationalities. Of course, we have our head office and flight operations in Iceland, but we have a growing team of people in Vilnius, in Lithuania, a great team of people there across all functions of the company. We have finance people, maintenance people, operations people, digital marketing, and a great team of really competent people there. And we are also really proud of the fact that we have a 50% ratio of male and female within both the board of the company and also the executive team. And this is something that we're proud of and want to show as an example for other companies, especially here in a listed environment in Iceland. I want to welcome, and having said that, welcome Þóra, our CFO, to go over our financial results, and then I will come back.
Thank you, Birgir. I'll be going through the financial results for the second quarter of 2022. The financial results for the period were negative, which was to be expected when considering external circumstances and steep ramp-up. The financial position of the company remains healthy, with an equity ratio of over 13% and cash position of just under 40 million. Q2 has certainly been a period of growth and expansion. We had a very steep ramp-up during the period, adding 2 new aircrafts, 14 new destinations, and started our hub-and-spoke model. This means we added a lot of capacity to our network. And put into perspective, we grew our production by nearly 200%, meaning we produced and grew threefold between quarters. And this, of course, needs to be kept in mind when looking at the financials, because all of these factors impact finances initially until established. And growth such as this would put strain on any business and its infrastructure. But I have to say that I am very impressed with the PLAY team, and they have somehow made it look so easy. Let's go over some financial highlights. We most certainly continue to focus on retaining cash and cost control. And we truly believe that we are managing to create a culture of cost awareness, which has been a goal of ours from the very start. Total revenue in Q2 was 32.5 million and grew nearly 240% between quarters. Yield continues to increase and increased by 5% between quarters. Ancillary revenue, however, is under expectations. EBIT was negative in Q2, as expected, as the company had yet to reach economy of scale. For the majority of the quarter, we had 5 aircraft in operation and added the 6th in June. It's not until we receive the 6th aircraft that we start seeing the economy of scale materializing, and we can see that happening already in June, July, August. We saw the price of fuel price skyrocket to record high levels during the quarter. But this has come down somewhat, but this of course affected PLAY's financials considerably. It is, however, exciting to see that unit cost of all cost items apart from fuel are improving. This was due to strict cost control, increased economy of scale, and with the introduction of the hub-and-spoke model. PLAY continues to have a healthy balance sheet with no external interest-bearing debt and a healthy cash position of nearly $40 million, which includes restricted cash of $6.3 million. Income statement. As just mentioned, PLAY has been in a steep ramp-up phase during the period without having reached economy of scale yet, and the financials again reflect that. We are, however, seeing the economy of scale starting to materialize in June, July and August since we received our 6th aircraft and launched the hub-and-spoke model in line with our business plan. That being said, total loss for the period amounted to 14.3 million. The main additional contributing factors for the loss being less revenue than initially anticipated and record high fuel prices. Total revenue was 32.5 million, of which 7.7 million were ancillary revenue. Revenue increased significantly between quarters with the introduction of the hub-and-spoke network and ramp-up of operations. Operating expenses, excluding depreciation and amortization, amounted to 39.1 million. Fuel cost accounting for over 40% of total operating expenses due to the high fuel prices. Staff cost increased between quarters due to hiring of staff, mostly crew members, relating to the ramp-up phase. During June, there was increased disruption cost, somewhat relating to the difficult situation at European airports that struggled with the staff shortages and subsequent delays. And we had the 6th aircraft on a short-term wet lease, which is not on our balance sheet, but hitting our P&L in June. Financial expenses were negative by 3.3 million, mainly due to interest expense related to lease liabilities. Operating income. If we look at the development of our operating income, we can see that RASK, or our unit revenue, is increasing, as was to be expected when expansion of the network and the hub-and-spoke model. RASK has grown 16% between quarters, and RASK for July increased even further and was 6.8 cents, whilst it was 4.9 in June. Average yield, which includes airfare and ancillary, in Q2 was $179 per passenger and increased by 5% between quarters. Ancillary revenue per passenger remains similar between quarters due to lower demand for cancellation protection, which is, however, an indicator that passengers are now more confident to travel, but there is also increased demand for carry-on bags rather than checked-in bags due to the difficult situation at European airports. Airfare revenue amounted to 24.8 million, representing 76% of PLAY's total revenue. Ancillary revenue amounted to 7.7 million, or 24% of revenue, and the portion decreased slightly between quarters due to the reasons just mentioned. Since launching our hub-and-spoke model, there has been a shift in currency combination where the portion of US revenue has increased considerably and in July represented 38% of our revenue. Operating expenses. When looking at operating expenses excluding fuel and emissions, we see a positive development of decline, which is in line with what we had anticipated. CASK excluding fuel was 3.6 cents in June and 4 cents for second quarter. And as shown on the graph to the right, we reached our goal of being under 4 cents already in May. CASK excluding fuel results in June show that with 6 aircraft in operation, having reached partial economy of scale with the hub-and-spoke model and strict cost control, we are starting to materialize our target of keeping CASK excluding fuel under 4 cents. This is crucial for our future profitability and proves that our efficient cost structure and efficiency is working. The donut chart shows that we have 53% of our cost in USD and 28% in ISK. This EBIT bridge shows the development of EBIT as units per ASK between quarters. The graph shows us that revenue and all underlying operational cost items except for fuel are improving and contributing to an improved EBIT. As shown on the graph, it's only fuel that is contributing negatively to EBIT. This shows us that we are on the right track and our underlying business model and structure is working. Balance sheet. PLAY continues to have a healthy balance sheet. The balance sheet amounted to 316.3 million at the end of Q2. We took delivery of 2 additional aircrafts during the period, one at the very end of June. The 5th aircraft joined the fleet in May, and therefore a new lease agreement was included among right-of-use assets, which amounted to 207.4 million. In June, there was 1 aircraft on temporary wet lease, which is not included in right-of-use assets. Intangible assets were 11.9 million and related to delivery of new aircraft and IT development. Trade and other receivables amounted to 28.6 million and increased by 22 million, which was mainly due to increased sales for the summer and is mostly acquirers' unpaid ticket sales. PLAY continues to hold a healthy cash position of 39.5 million, consisting of restricted and unrestricted cash along with securities. Shareholders' equity totaled 42.5 million, equal an equity ratio of 13.4%, keeping PLAY in a comfortable financial position. Liabilities increased in the period due to the liability relating to additional aircrafts and a significant increase in deferred revenue, which amounted to 40.2 million. Cash flow. Cash and cash equivalent amounted to 39.5 million and included restricted cash of 6.3 million at the end of June, which we expect to be close to a certain low point for the year. Net cash flow used in operating activities was 0.9 million, excluding restricted cash of 6.3 million. Negative operating cash flow before adjusting for changes in working capital was 13.8 million for the first 6 months of the year, driven mainly by the effect of COVID-19 and ramp-up of production. The positive contribution of working capital changes to operating cash flow was 16.8 million. The main driver behind the increase was deferred income and receivables related to forward bookings. Cash flow used for investment activities was 5.1 million, of which 1.8 million was due to deposits paid on leased aircrafts. Intangible investments amounted to 3.3 million and were related to investments in IT systems and infrastructure. Cash flow used in financing activities was 5.1 million, which consisted of repayment of lease liabilities and a share increase made to facilitate share option agreements. As we've mentioned numerous times today, fuel prices were at a record high level in Q2. As shown in the bridge graph here to the right, fuel cost in Q1 was 4.1 million, but increased to 16.5 million in Q2. The main contributing factors between the months are of course volume and price. But as can be seen on the graph, the increase in price contributed 4.8 million to fuel cost in Q2. The gain of our hedging contract in June was just over $200,000. To the right, we can also see a fuel price sensitivity analysis, where, for example, if price were to decrease to $800 per metric ton, which historically is quite high. Last year, when we were making business plans, we used 600, which was then a 5-year average. So 800 is not unreasonable, but would mean a decrease in fuel cost in Q3 by 6.4 million. But of course, fuel price can always develop in both directions. And if it were to go up to $1,500, that would mean an increase in fuel cost of 7.6 million. As stated in the graph, current market price is around $1,120. The fuel market is volatile and can shift large numbers, and that is why it's important to buy some certainty by hedging a portion of expected fuel consumption. We have increased our hedging portion to 30% of estimated consumption 1 to 3 months forward, that is July through September, and hedged 15% 4 to 6 months forward, which is October to December. This is within our hedging policy, which states that we can hedge up to 60% 6 months forward. But we want to take cautious steps in this volatile environment and build our position gradually. And to summarize, all in all, Q2 results were impacted by record high fuel prices while the operation was ramped up for summer 2022. The hub and spoke model is now up and running with a positive effect on the business, including improved aircraft utilization, unit cost declining below targeted of 4 cents, and improved unit revenue. And that's it for me. And I'll hand it back to Birgir, who is going to go over the update and outlook.
Thank you very much, Thora. once again showing the history and basically the transition that happened on the second quarter. And here we're talking about the changes in capacity. If we go back to July last year, obviously we had various waves of COVID coming back and forth, restrictions and all that. So we were constantly adding capacity, taking capacity off the table, and changing basically, of course, the revenue capabilities of the company until we come into April and we really ramp up the capacity. We foresee now that we are into, let's say, the normal fluctuations of the aviation industry, whereby we try to add capacity in the summer, we try to take a little bit down of the capacity down in the winter and in the months that we don't have a lot of demand. Let's say, for example, in this chart, September, November, we know that there's demand in December, we know that there's more demand in October, so we try to basically reduce a little bit in the month that we know that the market is demanding. But that's a much more normal dynamic than having to fight some virus. So we, again, this is another way to explain that we foresee that we are out of that kind of scenario where we have to really be kind of reinventing the company every 3 or 4 weeks. And we also see that the forward-looking booking curves are very strong. This is a comparison to the same point last year. Of course, the market is different than it was last year. We're out of COVID and the confidence of the consumers has returned. But it's nonetheless interesting to see that we see much more stronger booking situation and status into the, let's say, until the end of the year than we did last year. And we can see that the market is beginning to behave like it would in a normal year, whereby you have a certain period of time before a month or departure of a flight, and you can basically almost plot to the day when the demand begins to pick up and how the market behaves. That was not the case last year, and it's really comforting to see and gives us more solid ground to stand on for the future that the market is beginning to behave like it has done historically if you have the data and you have experience to read the data. Having said that, things can happen like we have seen in the last 1.5 years, but as things are looking now, we are very confident for the future. We are adding a few destinations in the winter. We will start flying to Liverpool in October. I'm personally very excited to go and see where Beatles grew up, but I'm also told that a lot of people like to go there to see the football. But that's one part of the market. The other part is people in that area going to the US, which is also always our focus. So transit passengers via Iceland to the US from the Liverpool and that area, which kind of also includes the greater Manchester area. And in the new year, we will launch flights to Geneva in Switzerland as a ski destination, which is, of course, mostly for Icelandic people going for skiing holidays. And we will have Geneva and Salzburg like we did last year. With new aircraft comes the need and the opportunity to add new destinations. And we will begin to do that for next year and next spring, where we will begin to service a lot of new destinations because we're adding 4 new aircraft. And we will have 10 aircraft from next spring. The first destination we announce is that we're going to Washington Dulles. We launched flights to Baltimore, Washington in April, and that has been a massive hit. We've seen great load and great demand, and the reception has been great. So we're adding the other airport in that area, which is, let's say, on the other side in the catchment area. And we anticipate this to be a great success as well. So we will launch daily flights from the 26th of April. This is a growing area, very affluent. A lot of businesses setting up shop there, and a massive market for transatlantic tourism and aviation traffic. So we are really excited about this. So this is the way our route network basically looks now. It's beginning to look like a real airline. But having said that, we will have more dots to announce in the coming weeks and months, as well as adding frequency to existing destinations. So, having said all this, we are out of the, let's say, the initial ramp up and build up phase. What are our priorities for the coming months? Number one, we need to add new revenue streams and strengthen our revenue basically capabilities. We do that with twofold. We will ramp up our cargo operations, and we are starting our cargo operations these days. We deliberately left it a little bit after the fact that we launched passenger flights, because we wanted to basically make sure that the operation is going well. Our new handling agents are functioning, and also the situation in the airports, as has been mentioned many times, has been challenging. And by cargo operation, I'm not talking about separate cargo flights. I'm talking about, transporting cargo on our existing flights, which adds operational complexities all the same. So that's also another business, so to speak. But that's happening these days, and it will add substantial revenue to the company. And then we know that we have a list of things to do to improve and kind of develop our digital service and our opportunity to generate extra revenue, especially ancillary revenue. Number two, we have to continue to monitor the market and react to the changes in the market. All kinds of economic developments, geopolitical developments, COVID-19, thankfully we won't see that too much as a disturbing factor again, but it could come back. But it also has to be said that it also can be positive, because we have also been adding capacity. For example, a few weeks ago, we added quite a number of frequencies to the US and to selected cities in Europe, because we're seeing great demand for November and December. So it's not only to reduce capacity, it's also to add it, because we see an opportunity in the market too. So we have to behave opportunistic, and we have to kind of be very dynamic in the way we control our capacity. And like Þóra said, and basically it's a mantra and a cultural theme in this company, just focus on the cost. Reduce our CASK, and that's basically a song that we sing every morning here. We just want to do things better and spend less money on it, so we can basically make sure that we are a profitable company. And of course, the third point, which will be a theme throughout the winter, is to take the next step in the expansion at these 4 new aircraft. It means that we will have to hire around 200 new staff to the company. We will have to add new destinations and basically do this in a manner that protects our cash and is efficient and economical, and streamlined. We also want to give a little bit of a detailed guidance to how we see the year end, and again, this is very, very impacted by the transition of the company now in the second quarter, because there's a massive transition in all the numbers, and I think it's interesting for people to realize just how what this transition basically means in numbers on a yearly basis. We foresee that we will transport around 800,000 passengers in this year. We foresee that our turnover will be 150 to 160 million US dollars, which is about, well, let's say 20 billion ISK or kronas. We will continue to keep our CASK ex-fuel under 4 cents, like we have said a few times here today, and you can realize how much of a mantra this is, because we've said it like every 3 minutes here today. By that, we're always talking about the later half of the year, because again, the transition that happened, this is a completely different company now than it was 6 weeks ago. So this is the later part of the year. And as we have said before, we foresee that we will have a positive operating profit, or EBIT, in the second half of the year, which I think it's a great achievement for a new company in the first full year of the operation, for a startup company, especially in this environment. And just to give a few key takeaways, like I said, these 800,000 passengers, the turnover is 150-60 million. Positive operating EBIT. We will have 4 new aircraft coming in, hire 200 new staff, and roll out new destinations. And like Thora said, we have a very strong cash position. We have a decreasing unit cost and an increasing unit revenue, which is a very good cocktail to drink. And so we can look really positively to the future, and we absolutely look forward to coming here in a few months' time and tell you about the third quarter. And we're very positive that we will have very good news then. Let's go to the questions. If there are questions, I'm told that we will see some questions. Okay, well, we have some interesting things. First question is, how many of the 200 employees that will be hired are pilots, flight attendants, or in other fields? Well, we are mostly up to the size, let's say the administrational size of the company. I don't think we need to increase our, let's say, fixed cost too much with the addition of new aircraft. Of course, there will be a few people and like that, but the vast majority of these new people that are coming in are basically crew, flight crew and cabin crew. A big majority is cabin crew. I'm not quite sure about the numbers. I would say the pilots are probably 50-ish, and the flight crew or the cabin crew is about 150, roughly like that. But there are other dynamics. But this is kind of the major split. Question number 2: how does the inflation in Europe and the USA affect customer groups that travel with planes, since Iceland as a destination is getting a lot less budget friendly? Well, inflation is bad for everyone. We can agree on that. The good thing about us is that we can mix our destinations, basically. So if, like we saw this summer, where Iceland as a destination was basically sold out, we can basically shift our focus more towards the transatlantic traffic or the via traffic. In an inflation, of course, some people will not travel. Other people will travel, but they will look for the most economical ways of getting from A to B, and this is our position in the market. So I think that we have a greater chance of reaching the more budget-conscious passenger. And I'm not going to say this is positive for us. By no means is that true. But if people are looking to fly and basically pay less for it, then we are the right choice to make. We have another question about the situation here in Iceland, that we have loose, or basically we're going into a negotiation period of union contracts, or for the kind of local employment environment. Our collective agreement has still a few years to go, so we are not, as a company, going into a negotiation phase. But of course, we are impacted by all kind of general changes that happen in the environment. But we haven't planned as such for that. We just roll with the market, and if there's a need to increase salaries in Iceland because everyone else has to do it, then of course we will have to do it as well. But our union or collective bargaining agreement still has 2 years, 2024 or something to go. And then a follow-up question. Sorry, I'm taking all the questions so far. Is it possible that we will hire people from abroad, or let's say non-Icelandic people? Like I said before, we have already people from 17 nationalities. We hire the best people that apply for the jobs. We don't go by passport, but the people that work or play are all paid by the same union agreement. You know, and regardless of nationalities, you know, we are not going into any kind of crew. What's the word for the kind of agency or crew, kind of foreign-based crew? I forget the word. So fully employed people here in Iceland, paid by this very nice union agreement we have here. Do we have something else? No, no more questions. I took all the questions.
That's fine.
You want to say something?
I'm good.
Okay, thank you very much, and we look forward to coming here again and telling you about the third quarter in in the early part of November.
Yeah.
Thanks a lot.